Hey everyone, welcome back to Corporate Decoder. Today BHR just filed an 8K about dividend announcements, and I am seeing a pattern that investors need to understand. Quick note, this is not financial advice, just my take on public filings for educational purposes. This report highlights how dividend decisions can reflect a company's financial health and future outlook, especially for preferred stockholders. This filing is from Braemar Hotels and Resorts Incorporated, a real estate investment trust, or REIT, that owns hotels. You might know them by their ticker symbol bar. The main piece of news here is about dividends. The company announced that on the 23rd of April 2026, their board of directors decided on the dividend payments for some of their preferred stocks. This includes their 5.5% Series B cumulative convertible preferred stock and their 8.25% Series D cumulative preferred stock. They also mentioned dividends for Series E and Series M redeemable preferred stock. This isn't a huge surprise for a REIT, as they're generally required to pay out most of their taxable income as dividends to maintain their tax status. However, the specifics matter. What is interesting, and perhaps a bit concerning, is the context around these dividends. We've seen recent headlines wondering if public shareholders are truly sharing in the hotel owners' proceeds, and if the sales process raises uncertainty for preferreds. They also provided some numbers on their Series E and Series M preferred stock. As of the end of March 2026, there were over 11 million shares of Series E and nearly 1.4 million shares of Series M outstanding. These are substantial amounts, meaning the dividend payments themselves will be quite significant for the company's cash flow. Now, let's look at what all this means. The company's common stock is listed on the New York Stock Exchange under the ticker BHR. They also have preferred stocks listed, including Series B under BHR-PD and Series D under B.H.R. PD. These preferred stocks represent a claim on the company's assets and earnings that is higher than common stock, but typically comes with fixed dividend payments. The filing confirms the different classes of stock. You have the common stock, which represents ownership and voting rights. Then you have the preferred stock, which is like a hybrid between debt and equity. It pays a fixed dividend, and in this case, the Series B is convertible, meaning holders can convert it into common stock under certain conditions. The Series D and other preferreds mentioned are cumulative, meaning if a dividend payment is missed, it accrues and must be paid before any common stock dividends can be issued. Looking at the broader picture, this announcement comes hot on the heels of news that Braemar Hotels and Resorts is set to announce its first quarter 2026 financial results on May 6th. This dividend declaration made just before their earnings report can be seen in a couple of ways. On one hand, it signals confidence from the board that they can meet their obligations. On the other hand, some investors might be watching closely to see if these dividend payments are sustainable, especially given the ongoing discussions about the company's asset sales and overall financial strategy. When a company like this pays out regular dividends, it is a sign that they expect predictable income from their properties. However, if their hotel occupancy or average daily rates dip, those dividend payments can become a bigger strain on their cash reserves. It is like a household budgeting for a fixed mortgage payment each month. If income drops unexpectedly, that payment becomes much harder to manage. The fact that they're reiterating these dividend payments for preferred stockholders, especially the higher yield Series D, shows a commitment to those investors. But it also means that if the company runs into financial trouble, these preferred dividends are a priority before common shareholders see any return. This is why understanding the specific terms of preferred stock is so crucial. For example, the 8.25% Series D preferred stock means that for every $100 of face value, the company owes investors over $8 a year in dividends. With millions of shares outstanding, that is a significant outflow. What I'm actually looking for in the upcoming earnings report is how well the company's operations are supporting these dividend commitments. Are the hotel revenues strong enough to cover not just operating expenses, but also these substantial preferred dividend payments? Any hint of strained cash flow or reliance on asset sales to fund these payments would be a red flag for me. The research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If you found this breakdown helpful, please hit like and subscribe. Let me know your thoughts on the company's dividend strategy in the comments. And join our Discord community linked below.